walk you through a couple of these exercises so we kind of get the hang of our homework for this chapter. The first exercise I want to walk you through is 8-5, and it kind of goes through some of the journal entries in this chapter dealing with the allowance for doubtful accounts. There's a lot of journal entries in this chapter, so just be careful of the accounts that we use and when we should use which ones. So hopefully I'll help you through a little bit of that now. So let's look through each of these. The first one in A, they're using the direct write-off method. That's something that we always want to make sure we know. Are they using the direct write-off method or the allowance method? Here they're using the direct write-off method. So when somebody doesn't pay us, all we're going to do for A is we're going to debit our bad debt expense and we're going to credit that account receivable. And it will be for the amount that is uncollectible. Remember that bad debt expense is only debited if we're using that direct write-off method. In B, you'll notice they switched to the allowance method, and it tells us it has the allowance for doubtful accounts has a credit balance of $2,100. Remember, your allowance for doubtful accounts should have a credit balance. That's its normal account balance because it is a contra asset account. It attaches itself to that account's receivable to show how much you're actually going to collect or your net receivables. So for B, the first thing we have to figure out is what should be in our allowance for doubtful accounts. They tell us that it's 10% of our accounts receivable. They're always going to give you that sales revenue and sales returns to see if you know what you're supposed to use. So what we're going to use is that account receivable balance, which is $110,000, and we're going to times that by 10%, which gives us $11,000. That's what we want our ending balance to be in that allowance for doubtful accounts. So when we look at that account balance, there's our ADA account. We know it has a normal credit balance, and we want that ending balance to be $11,000. It tells us right now we have a current balance of $2,100 as a credit. Now our journal entry is for what we're going to fill in that blank to get down to that $11,000. Another way you can look at this is taking that beginning balance, $2,100, subtract your ending balance of $11,000, and that's going to give you the adjustment amount. And the adjustment amount here is $8,900. Because if I put a credit here of $8,900, I will get to that balance I want. The journal entry at the end of the year to get that allowance to where you want it to be is to debit your bad debt expense and credit your allowance for doubtful accounts. It's a long account name, so that's why I tend to use this ADA, if it's too long to write. And our journal entry is for the adjustment amount of $8,900. And finally, that last one, it says, if our allowance for doubtful accounts had a debit balance of $200, then what would that adjusting journal entry be? Well, it is possible to have that debit balance to be $200. It just means that we didn't guess the right amount last year. More people didn't pay us than what was expected. In this last situation in C, their estimated uncollectibles are to be 6% of accounts receivable. Our accounts receivable stay the same at $110,000, but now we're going to times it by 6% to get to that amount of $6,600. Now again, this is the amount we want as the ending credit balance. So let's look at what kind of adjustment do we need to put in our allowance for doubtful accounts to get to that amount. We can also look at it the same way we did before, our beginning balance, but now because we have a debit, we're going to have that as a negative. We're going to subtract our ending balance of 6,600, which gives us an adjustment amount of 6,800. So if I put that 6,800 in as a credit, then that would give me that total balance of 6,600 that I want. And then I could do that journal entry, debit that bad debt expense. It's for that 6,800 amount, and credit my allowance for doubtful accounts of 6,800. So that's a good example of how we adjust our allowance for doubtful accounts. Now let's look at what happens when somebody doesn't pay us. Oh, that's this one. Alright, so this is exercise 8-7 that we're going to look at. And this one gives you a different scenario. And I'm going to keep track here of our allowance for doubtful accounts because it's going to be important to look at. So it tells us that we have a credit balance of $15,000 to start with. And then it tells us that we wrote off accounts totaling $11,000. Now remember, when we write off accounts, this is that first journal entry that they want. When we're using the allowance account, we're going to debit that allowance for doubtful accounts, and we're going to credit that account receivable. This is because we've already recognized that bad debt expense at the end of last year when we did those adjusting journal entries. So when we write off an account, it was for $11,000. We debit that allowance for doubtful accounts, credit our account receivable. I'm going to keep track of this. You'll notice here, I'm going to put in that debit for $11,000. The second part of this is saying that one of those accounts was actually collected later. What we're going to do then is always start with the debit our account receivable, and we're going to credit that allowance for doubtful accounts. I'll just abbreviate. And that's for the amount that was actually paid. So you can see here now I have a credit of that $1,800. So at the end of the year then, the last thing says that it shows that we should have an ending balance of $19,000. So we want that ending balance to be $19,000. The question is, what do we have to put in here to adjust it to get to that amount? The first thing I might want to do is find out what our current total is. And if I add up my debits, add up my credits, my current total is $5,800. So that means, again, I could take my beginning balance that I'm starting out with, $5,800, subtract out that ending balance of $19,000, then it means I need to adjust for $13,200. So when I write that journal entry, I'm going to debit that bad debt expense for that $1,300, and I'm going to credit that allowance for doubtful accounts for $1,300. And that credit is shown right there to make that ending balance be accurate. And the final exercise I want to show you is looking at these notes receivable. The notes receivable in this chapter we go through, if an account receivable isn't paying us, we can set up this notes receivable and then charge them interest and have a set due date. So that first entry saying we received a notes receivable in exchange for an account receivable, all we're going to do is set up that account, that note receivable with a debit, so it is an asset, and we're going to get rid of that account receivable. And even though this now has interest and everything else, we only record interest when it's due. So this is for that $9,000 amount. The second piece, on December 31st, we have to accrue that interest. Remember chapter 4, we go back and look at those adjusting journal entries. We need to bring that revenue and expense up to date. So this is part of that at the end of the year. So when we record our interest that's due to us, we are going to debit our interest receivable. We haven't gotten it yet, but we've earned it, so we need to record that, and credit our interest revenue. Now this chapter goes through that equation. We're going to take our principal amount times our rate times how much time we held it. We've held this now from May through December, which is 8 months. So I will times that by 8/12 to get to 360. In part C, what they want you to do is close that revenue account. Again, this is a reminder of chapter 4 when we're closing all of our accounts. Revenue is one of those temporary accounts that we close. We close a revenue account with a debit. I will debit that interest revenue. And I'm going to credit, if you remember, income summary. I hope this is a good reminder that at the end of the semester here we will have a cumulative final that kind of goes back and reviews some of this stuff. So you're going to want to remember that. And we just do it for the same amount. And then finally on May 1st, we have to record the payment of that note. We're going to get cash. That's our debit. We're going to leave that blank for right now. But look here to this note. We want to show that being paid, so we're going to write that off as a credit to bring that balance down to 0. Here's another receivable that they owe us, so let's show that that's going to also get paid. So we'll credit our interest receivable. And then they owe us some more interest, some interest revenue for the remainder amount from January 1st through the end of April. So I'm going to take that 9,000, multiply it by that 0.06, multiply that by 4 months, or 4/12, and that comes to 180. So then I can figure out the cash that I received just by adding up all my credits. 9,540. So I hope this helps and gets you started. Let me know if you have any questions.